Candlestick Basics, presented by finvids.com, Finance Videos. This video introduces the bearish and bullish candlestick and the associated terminology. For individual candlestick patterns, please see those individual candlestick pattern pages at finvids.com. A bullish candlestick occurs when the close is higher than the open. In contrast, the bearish candlestick occurs when the close is below the open. The real body is the area between the open and the close. The upper shadow is the difference between the top of the real body and the high, and the lower shadow is the area between the low and the bottom of the real body. There are many ways to define a long bullish candlestick. Steve Neeson suggests that the real body should be at least 3 times as long as the previous day's real body, whereas other people suggest that the difference between the high and the low, 90% of that should be the real body. Either way, the main point is that a long bullish candlestick summarizes the intraday trading. This chart shows an intraday 15-minute chart showing that throughout the day, prices moved higher. All of the price action in one day can be summarized with one candle. The uptrend is summarized by a long, bullish, green real body. This is an example of the most bullish candlestick. It's called a bullish Marabazoo. Notice that the open is equal to the low, and the close is equal to the high. Note that there are no upper or lower shadows. The bulls started the day in charge and ended the day in charge. A slightly less bullish Marabazoo is called the closing bullish Marabazoo. Notice its small lower shadow, but also notice the close is equal to the high. What this means is that prices opened, but bears were able to push prices a little lower, creating that lower shadow. But by the end of the day, bulls were in charge, closing at the very high of the day. The weakest form of the bullish Marabazoo is the opening bullish Marabazoo. Notice that the open is equal to the low, meaning that the bulls started out the day with strength, but also notice the upper shadow. The upper shadow suggests that bulls pushed prices high, but bears were able to push prices lower to the end of the close. This weakness at the end of the trading day suggests that bulls weren't completely in charge. There are multiple ways to define a long bearish candlestick. Generally speaking, if the real body is at least 3 times as long as the previous day's real body, then it's considered a long bearish candlestick. Or the real body is at least 90% of the area between the high and the low. The main idea is that the trading session can be summarized by one candlestick. This chart shows an intraday candle chart superimposed upon a single bearish candlestick. Notice that by seeing the bearish candlestick, you have essentially understood what happened during the intraday trading session, mainly that prices dropped throughout the day. The most bearish candlestick is called the bearish Marabazoo. Notice that the open is equal to the high and the close is equal to the low. Note that there are no upper or lower shadows. The bears began the day at the open and pushed prices lower all the way until the end of the day at the close. A less bearish Marabazoo is called the closing bearish Marabazoo. Notice that it has an upper shadow and its close is equal to the low. The bears open the day, but the bulls are able to push a little higher, creating that upper shadow. However, the bears end the day at the close, which means they were in control for the rest of the day until the close. The least bearish of the bearish Marabouts is the opening bearish Marabou. Notice that the open is equivalent to the high and that there is a lower shadow. What this means is that the bears started the day completely in charge. However, at the end of the day, bulls were able to push prices a little higher, creating that lower shadow. In this chart of the S&P 500 Spider Exchange Traded Fund, the bullish candlestick is used to confirm an area of support. Notice that the bullish candlestick rises off of the area of support and gives strength to the area of support. Prices head higher. This chart of the Energy Spider ETF illustrates that bearish candlesticks can confirm areas of resistance. A resistance line is drawn at a prior high, and when prices reach the resistance area again, a bearish candle is formed, rejecting prices at that level. Prices then fall. This chart of the Dow Jones Industrial Average Spider ETF shows an uptrend that is confirmed multiple times by bullish candlesticks. This chart of the Silver ETF shows that bearish candlesticks confirm the downtrend resistance area. When established resistance is broken, it is usually seen being broken by a large bullish candle with high volume. Similarly, this chart of the S&P 500 ETF illustrates support being broken by a large bearish candlestick. This chart of the Energy Spider ETF shows a common 50-day moving average acting as support. Every time prices reached the 50-day moving average, a large bullish candlestick confirmed the average. Please see the text content and image content below the video at finvids.com for more details and in-depth descriptions. In summary, a bullish candlestick occurs when the close is greater than the open. A bearish candlestick occurs when the close is less than the open. Bullish candlesticks often rise off an area of support and confirm that support. Bearish candlesticks fall down off of resistance, confirm that resistance. Often large bullish candlesticks are found when overhead resistance is broken, and often long bearish candlesticks are found when support is broken through. Again, for more detailed information, explanations, and chart examples, please see finvids.com. And don't forget, there are numerous candlestick patterns at finvids.com, each having their own in-depth video and description.